All right, Chris, it is Christmas week here in the United States, and we are going live to talk about the markets and the economy. Always one of my favorite times of the week to wrap it up and talk about things that you and I spend way too much time and hours of our life paying attention to. But we're filming at 10 o'clock, a little bit before market close, a few hours. But I think we can get a pretty good read today based upon what the market's been doing. Certainly some volatility back into the market. We're going to talk about that. A little bit of a broken week because of Christmas, but we did get some Santa Claus rally at least. And we'll talk about why and what we're looking at and how we're going to size it up to see where it goes moving forward. We'll be right back after this. All right. Well, coming in strong with the meme today, Chris. Nice work.
Found this one last minute. It was a sign from the universe, Daren. Fell right in my lap.
It's so funny, like visual. How true that is, though. Like you see it over and over, and Nvidia's just ripping. Everybody wants in, and when it's going down, nobody wants in. And saying you see it a lot. I think it's more exaggerated in the crypto markets. But
yeah,
certainly
we're herd animals. We are herd animals. We find safety in numbers.
That's what
perceived safety.
People have always said, like, Daren, you did your master's in psychology, etc. How'd you get into the stock market? I get that a lot from people, and especially when they're interviewing me as clients. And I always tell them, like, the market is, like, in my opinion, like the perfect manifestation of the human emotion process and how us humans experience emotions. And you learn this the more you get into trading and the more you talk to traders. The traders that are really good actually spend a ton of time around emotional intelligence, around understanding their emotions, why they behave the way they behave, creating different mechanisms to help them manage their emotions, because so much of it is driven by our emotional experience. And fundamentally, the market is an emotional thing, right? It's a manifestation of emotion.
Absolutely. Psychology and human behavior. And, it's one of those things where you can study these things all day long, right? And read about them in books and, but even going through it yourself, right? You like have to check yourself sometimes of like, oh, I think that's recency bias, or I'm anchoring to a price that I paid for something, which the market doesn't care what you paid for anything, right? There's the confirmation bias, right? Where we see what we want to see that follows our narrative, and we basically reject anything that counters our narrative. So even when these things are out there, navigating this is still really tough. Now, this quote from Howard Marks, who's one of the great investors out there, one of the guys that Warren Buffett says he actually reads his memos regularly. And he says, the thing you have to worry about is the thing you haven't thought about. And I think that's so true when you look at risk. We always talk about the fact that, the market prices in everything that's known. So all the stuff that you hear in the headlines that's, hey, this is a worry, whether, today we're going to talk about US debt, and we talk about that a lot. It's a known thing to the market. Valuations are a known thing to the market. It's always the things that are unknown to the market that are not priced in that end up popping up. And I think if you invert this idea, it's not only the bad things, it's also the good things, because oftentimes clients will say, well, I read in the journal that, blah, blah, blah about this company. Okay. So did everybody else, right? That's already been baked into the price. And where the human psychology comes in is sometimes those things get overpriced based on an overly optimistic view of how things are going to happen, or underpriced based on an overly pessimistic view of those things that are known to the market. So, that's a real brain buster that's a constant in the investment world, that we all need to struggle with and fight against those tendencies that we all have to kind of shoot ourselves in the foot when it comes to investing.
Well, and I think too, like anything that you have a really strong conviction about, like you have to ask yourself that question: what do I not know that I don't know? Right. And that's a hallmark, I think, of a good investor, because when you talk to people that are just, oh, this is going to go up, it's going to go to the moon. I mean, if I had a dollar for every time I've heard that over the years, I'd be a very wealthy human at this point. But um, it's usually those strong convictions we feel inside of us that are our biggest traps. And the opportunity is to step aside and step back and to argue and debate it in your own mind of like, well, here's where I could be wrong. Right. And I always look at, if I have an investment thesis on something, I also need to have the alternative thesis for that investment. So if I say, hey, I'm really passionate about Microsoft, for example, it's going to do really great, da, 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 da. I should also have in my mind in the space, here's why Microsoft's not going to do well. And at the end, I could choose still to lean into that trade, but I have the oppositional thinking in place. I think that's the only way to look at investing. Without that balance, it's just a matter of time before you get beat up pretty good.
Yeah, this was very cool from Jim Bianco posted it, but I believe this is from Visual Capitalist, um, and they're showing a world of debt. So the share of debt by country, so the bigger the square, the more debt the country has, and then it's got the little heat map up to the right, debt as a percentage of GDP, which is normally how debt is kind of quoted. So just like if you were looking at a person's debt, it's like, oh, you say someone's got $100,000 worth of debt. That doesn't tell you much unless you also know their net worth, their income. Is that a lot? Is that more than they can bear? Or is it insignificant? Right. So it's going to differ based on the size. So usually debt for countries is quoted as a percentage of GDP. And this is one we've been hitting on a lot lately, which may be the reason or one of the reasons why interest rates are continuing to chug higher, even though the Fed is lowering rates on the front end of the curve, or the short-term interest rates. The market is really rejecting that, and on the long term, those rates are going up. And part of that could be that investors need a higher return for the risk that they're taking with the debt. And a lot of the debt that's been issued over the last couple years was issued very short term, and it all has to be refinanced and basically sold again. And so interest rates continue to move higher, which you wonder how long asset markets just continue to kind of digest those higher rates, because higher rates means that money costs more. Money is just a commodity, and but it's a commodity that goes into everything. Small businesses, we all use it, right? And so if that thing that we all use costs more, that leads into a lot of other areas within the economy. And so it's yet to be seen how the stock market continues to show strength in despite these higher interest rates. Luckily for the bond market, the interest rates are quite a bit higher now than they were the last time we saw these spikes. So you're not seeing the total bloodbath in the bond market that you saw in 22, and going into 23, because we were coming off of record low interest rates, and now we've got decent yields on bonds. So despite rates going up, yes, bonds are struggling, but they're not getting absolutely completely smashed like they did in 21, 22, and 23. So, I think it's going to be a very, big thing to navigate for all of us in the U.S. Moving forward over the next 5 to 10 years is how do we navigate around this debt to GDP level and do so in a way that doesn't cause too much havoc. All right, so we've got the sentiment indicators this week. Big drop in the bullish sentiment. Look at where we were to start December and look at where we're ending December. We're dropped about 10 percentage points in bullish sentiment. You'll have that S&P's down on the month. The U.S. small caps are down even more, and so nothing leads sentiment like price. So, we kind of talked about that though, where if you look at the bullish high was back in July, of course, but we started December pretty rocking and rolling at almost 50. When you get up to 50, close to the 50 on the positive sentiment, that's usually okay, pump the brakes here. Everybody's partying pretty hard. The CNN Fear and Greed Index is up slightly to 33, still in the fear zone, up slightly from last week at 28. And the Bitcoin is unchanged at 74 greed on the week.
Bitcoiners still being greedy.
So this was a cool chart from Lance Roberts. I'm surprised I haven't really seen this put this way as much, but we've talked about how the tech stocks have really been the whole story in the U.S. There's record concentration in the U.S. markets. There's just a handful of stocks where if you took those out, last week we showed the chart where if you took out just one stock, which was Nvidia, it took out all the outperformance that the U.S. has had over Europe since the start of the bull market in 22. And, but Lance Roberts here is showing, hey, the reason for that, and probably the reason why we're seeing sideways markets in most of the other stocks is because the earnings outside of U.S. tech stocks has really, the earnings have also gone sideways. And so stocks in general tend to follow earnings growth. And so if you're not getting any earnings growth, those stocks are going to sputter out, which is basically what we've seen. I mean, you look at U.S. small stocks, they've been basically treading water for 4 years now, sideways. And so, if you take out those top 10 stocks, top 7 stocks within the S&P, many of those stocks have really gone nowhere for several years now. And that's because, according to this chart, earnings have also gone nowhere over those last few years. So really just seeing that concentration in the market continue. And hopefully we'll start to see some broadening out of that strength into some other stocks, because this was also from Lance Roberts, showing the largest stock relative to the 75th percentile stock in the light blue. So we're definitely at an extreme compared to where we've been historically. And then same with the weight of the top 10 stocks. Both of those metrics. Now, I know we could probably both find several analysts that say, yeah, but this time is different. These are the best companies that have ever been created. We've got a new economy now. We've got AI, money printing, yeah, all the things. So you could probably find people that say, yeah, we'll look at this chart 10 years from now, and it's going to even dwarf this. You have the other side of the argument that says, no, historically, these things tend to mean revert, and we're just at extremes right now. And, 5 to 10 years from now, we'll be looking back at this going, it was so obvious. How could you be so concentrated in those stocks? It was so obvious, so we'll see which way we end up going. It's impossible to tell, of course, when you're in the midst of the storm.
That, I mean, if there has never been a better chart for this time is different, that's it. Like you look at that chart and it's scary how consistent it's been when you get this concentration. Uh, there's been a bubble, and UBS came out, I think, earlier today or yesterday, and said that all the conditions for a bubble have been met. So everybody's on notice, right? And this is
I like,
why we preach diversification over and over, even when it doesn't feel good.
yeah, it particularly feels awful right now. Meb Faber has the best phrase for it, where he calls it a bear market in diversification. And boy, is that true. Um, and I like the way Chivako puts it, Darren, and you probably know it better than I do, but he says something like, we want to look at what other traders have done in the same situation in the past, right? Going back to the human behavior. Do you remember exactly how he says that phrase?
I
So I think
don't.
it's a great phrase, but he looks at charts and he says, look, you're looking at what other humans with other biases and behavioral problems that we have today, you know, banking on the fact that human behavior has not changed, nor will it. And you look at what other humans did in this set of circumstances, right?
Right.
And you try to learn from it. But you're having all of those psychological biases flow through you, and you realize how hard it is, right? To make those changes. So um, here we're looking at the price to earnings of the Magnificent Seven and Netflix, and you look at the S&P X that. So when you include the forward price to earnings of those companies, we're at 32.7 or near highs, kind of no matter where you look at those valuations or which valuation metrics you're looking at. But then when you look at the S&P X, those companies were at about 19.4 forward earnings, which is kind of more in line with the average. When you include them all together, we're at 22.6. So on the high side, I believe the 20-year average is somewhere around 16 or so, 16 or 17. So, and then when you look at the 5-year past earnings growth versus the estimated growth from here, um, you can see that a lot of these companies are slowing down in terms of their estimated growth, and they've had just fantastic growth here over the last 5 years. So um, those earnings are really going to matter moving forward. How those come out, because right now we're priced to perfection. So this is the first week, Darren. I wish we had a way to like reference past slideshows like quickly. Maybe AI can help us with that somehow. But I'm always thinking like, gosh, what were we saying about this, 3 years ago? Because I feel like we've covered this topic previously, or like when did we bring up the actual yield curve inversion? This is the 10-year 3-month treasuries spread, and we are back to positive. So we have gone full circle, and we are disinverting, if that's a word now. And you can see in previous cycles when that has happened, the gray bars have been showing up not too long after that, gray bars being recessions. But this is a function of the big changes that we've seen over the last few months in the yield curve, or what you could think of as the difference between short-term interest rates and long-term interest rates. We've been in this couple-year cycle where short-term interest rates have been higher than long-term interest rates, which is not a natural state of being. We're getting back to nature is healing, as they say. And so it's going to be, sorry, kids home from school today.
All right, so let's go on. I'll have to pick up the next one here.
Sorry,
The
had to shoo the kids out of the office there. Christmas week. Uh, here's the 10-year treasury rate. So just to illustrate the difference in interest rates that we've seen since, this is going back to September 19th, which was when the Fed cut by 50 basis points. So, some may be saying, oh gosh, the Fed's trying to be political and hurt the new administration. This rate here is not controlled by the Fed. This is what the market is pricing in. And so the 10-year treasury rate has gained, as you can see here, almost a full percentage point since we've been cutting interest rates on the front end with the Fed and the Fed funds rate. So to me, this is the biggest story that's happening in the financial markets right now. What is the fixed income market or the bond market telling us? Is this expecting inflation? Is this expecting more growth? Both? Why are interest rates going up so fast in response to something that the bond market is seeing?
Did you listen to that Luke Groman podcast I sent you, Chris?
I started to, yes. And I think his position, correct me if I'm wrong, is that the debt situation is taking over. People are recognizing the US debt situation and not wanting to purchase debt from the United States and requiring, therefore, a higher rate of return in order to invest their money in treasuries. Is that kind of the upshot of
That was kind of
Roman's
that was kind of
outlook?
my read on it. Yep.
Yeah. So now we just looked at the 10-year rate. So that's kind of the longer term rate. That is the one that, credit card rates and mortgage rates and kind of all credit in the economy loosely gets based off of treasury rates in some way, because treasuries are considered to be credit risk free, meaning that the government is going to pay you back. Now, they have interest rate risk, they have duration risk, there's other risks, but from a credit standpoint, they're considered to be credit risk free. And so that's kind of what everything else is benchmarked to. And there's everything else is priced with a spread over those treasuries. So if those rates on the super safe stuff is going up, the rates on everything else are going to go up. So which I'm sure people are intimately aware of if they've looked at mortgage rates here lately. And now this is on the front end of that interest rate curve, which is the 2-year treasury rate, has also gone up significantly, not quite as much as 1%, but also, what were we at? Maybe like 340 when this started, and now we're up to 429 as of previous day's close. So interest rates across the curve are heading higher. Now, we haven't looked at this one in a while. I know this is one of your favorite charts, Darren, the M2
Yeah.
money supply.
Notice
Right
it
now,
kicking up now, though, right? And liquidity
yes,
coming into the system, right? So we've been saying this
yes,
for months now, saying, "Oh, the world's going to end if this person wins. World's going to end if this person wins. Doesn't matter what side you're on." And we've said over and over again, what matters is do they keep printing? And the truth is, they're both going to keep printing and just give it to different people. And the liquidity, money supply going back up. Not shocking that inflation's kicking back up. Now it makes some sense why the Fed would say, hey, we think we're going to be raising rates or lowering rates a little bit less than we thought next year. And I also think this is what the 10-year is telling us, right? 10-year saying, look, money supply is going up. In order for people to buy treasuries, there has to be more yield offered to it, because with money supply going up, that's inflationary for stocks. In order for people to continue to want to put their money in treasuries, it has to pay a higher yield.
yeah. And, if you're a believer in the Milton Friedman school of thought, where he's basically says, look, inflation is always and everywhere a monetary policy choice, where when you put more dollars into the system, you get more dollars chasing fewer goods, you're going to get price increases and you're going to get inflation. And um, our government's not the first to do it. Governments around the world have done it, especially when they get into debt. That's the way that they try to get rid of that debt. Now, the question, I think, importantly for markets is where's the cutoff on how high of interest rates can small businesses absorb? Can large businesses absorb? Can the consumer absorb? I'll never forget my college freshman biology courses, right, where they talk about the biological line. You get a plethora of rabbits. There's rabbits everywhere. The population of rabbits explodes. And there's like this natural line where, okay, then they start getting diseases and more predators come in because there's more rabbits to eat. And suddenly that population gets back down. So the market is a natural system as well, where there's going to be a natural limit to these things. Nobody knows exactly where those are, but interest rates can't just go up forever with no response from everything else in the system. There is a point where that cost of money makes something change within the system, and the question is kind of where is that, right? But it looks like with the money supply increasing, potential for tariffs, potential for we just got a better than expected jobs number. So the labor market is still doing well. And we'll see on the next slide here, another thing that's been feeding into inflation is that incomes are higher. Disposable incomes have actually outpaced inflation since 2020. This is going back to February of 2020. And when you look at employee compensation and disposable personal income, note those spikes from the stimulus measures that came out. And, we've continued to see the rate of incomes exceed the rate of inflation. So people are making more money, they spend more money, the prices are going up, as everybody's aware. And so I think that's going to be a real challenge because, as we've talked about, Daren, people hate inflation. They hate it. Even if they're making more money, even if their net worth has gone up, in general, when you get a lot of inflation in the system, it creates social unrest and problems. So I think most governments know that, and they know that they can only push the ball so far with inflation before it starts creating social unrest and chaos.
Yeah, it's inflation is the great tax, and I think it had a lot to do with this last election and how it impacts people. And I think you're right; people just hate it. And if people feel their paycheck getting inflated away, their behavior changes very quickly. All right, so let's just take a look first at the S&P 500. So we've got what's often termed the Santa Claus rally. And Chris, unfortunately, I think we're now, well, let's see. So this would have been Monday, Tuesday, Wednesday, Thursday, Friday. And earlier today, we were just barely negative on our Santa Claus rally, but we're maintaining it. We'll see how market closes. So these candlesticks represent one day in the market. This is the S&P 500, the largest U.S.-based companies out there. And you can see how the market's been doing. So we got that nice 4-day rally, and then Friday it came in back in the red. Now, you might be feeling a lot of fear. There's a lot of fear out there. But if we step back and really look at what the geometry of this market is right now, you can see this area is been really important from a check-in and consolidation standpoint, and this whole move upward. And right now, I would argue that that's all this is, that the market's just consolidating a little, taking a breather. You can see the fact that we held on to that 50 moving average, this long wick here. You can see right here it traded down into this area and then traded back up. And we found support on that 50 period moving average. We found support moving up through that average. So I would say right now, I think you need to run with the thinking that this is just a correction. I don't think it's turning down in a big negative way, at least from just what the chart's saying on the S&P 500, which is the largest US based stocks. We look at the RSP, which is the equally weighted S&P 500. So when we look at the SPY, what we're looking at on the SPY is is accounting for each of the bigger stocks get a bigger weighting in the market, and the RSP is an equally weighted. So every stock of all those 500 get an equal weighting, and you can see on the equal weighted chart that it looks a little bit more challenging. I mean, we just went through a lot of red. We broke that 50. We're still under, and we got rejected off that 9 EMA, which is that favorite trading range. We are looking like we're holding support right here at this 175 range, which was important back here, right? We would want to see more strength out of the RSP to feel like this market was going to be less lopsided. And we're not seeing that right now. So on that, if we just take it on the face in the RSP, things look a little more bearish on the equal weighted index. Although the equal weighted index has just struggled this whole way up. Why? Because that Magnificent Seven stocks that have done so well moving up, they have driven most of the market growth. All right, so let me take a look at ag. So ag is the bond market. So I think unfortunately for the bond market, it's not looking good. And this isn't going to look good for diversified investors. And here's why. So you can see market went up, went down, went back up, got rejected off this long-term trend line here. You can see how important this trend line was all the way up, and then got rejected and it's back down. We are going to maintain our 100-period moving average on the bond ag today, which I guess you could argue somewhat positive. This gold line here is that important 100-day moving average, and we're just sitting right on top of it as an important support level. So what do I mean by support? That means that when that particular investment or asset hits that level on the charts, that's when the algos, that's when buyers step in and say, oh, I'll take it for 96. Whereas the sellers are saying, well, when it gets up to these important moving averages, they sell it. And that's called resistance, right? Whereas the bottom is called support. So we have support on that 100-period moving average right there. But overall, you could argue that here's a double top, and you could argue that here's basically a neckline. So if we break that neckline right there, which coincides with that 100-period moving average, I don't think that looks good for the bond market. So right now, I'm looking like we're on the bullish side or bearish on the T chart for the bond market. When we look at, just take a 10-year, let's look at that 10-year real quick. So Chris talked about earlier about this inverted yield curve, and you can see the move up. That's looking like bullish for the reinversion of the yield curve, which isn't bullish for the stock market. Historically, when this reinverts and moves up, that's when you get your recessions kick in. So heads up on that. I'd say you got to look at that. That's this particular indicator has always been accurate. You know, maybe this time is different, but it's always been accurate so far. Take a look at oil. I've been talking a lot about oil and about this particular setup here and this descending wedge. So what we're looking for is a spike breakout in oil. What would do that, where you get a big breakout, something like that, would be something related to probably some kind of strife in the Middle East. We're still in that period of time now with Christmas behind it. It'd be really interesting to see what Israel does. The Houthis have been launching rockets at Israel, and Israel's been striking back. And with Hezbollah down, Iran now not nearly the proxy supporter it used to be because Hamas and Hezbollah are gone, or well, they're not gone, but they're very diminished. You could see some heat around the Houthis and potentially even Iran, albeit Trump has voiced so far, and what he said to Netanyahu was, hey, do what you got to do to take care of Iran. So that would be the set of geopolitical circumstances. I'd be looking for an oil spike, an escalation in the Russian-Ukraine war. I would see a spike in, but that's when we saw this last big spike in oil. And you've got this big descending wedge here. So to me, what that's the market whispering to us that there's some kind of geopolitical macro environment in risk coming on board. And if you view it like the pressure's winding up here, that's at least what that particular chart is, where they're going to break down or break up at this point. Usually when you get a consolidation of volume like that and price action, something's breaking. And what it will be, we don't know, right? I just find it always so fascinating how the charts are whispering something is building, but then something happens and it's like, oh yeah, that's the event. Makes perfect sense in retrospect. There's certainly something building there. Typically, you don't get these winding events like this without some sort of breakout. And you can see moments where you've had that kind of wind up and break in the chart. Here's another one way back over here. So anyway, just something to watch and be mindful of. And why that's so important is because if you think about all the consumer goods in your house, they're full of oil. You put gas in your car, oil. Oil is one of the primary materials in our consumptive society. All right, let's take a look at mortgages. This is not good. I saw a stat this week that said that we hadn't sold so few homes in the United States since 1995. I think the only thing keeping the housing market together is that there's a huge portion of the baby boomers have their homes paid off, and there's a lot of people with low interest rates keeping it together because of that. But mortgage rates being high at where they're at, hovering around the 7% threshold, it's just really put a lot of slowdown on the markets. The housing market. So we look at the VIX, a measure of the complacency of volatility, or the complacency that the traders who trade the S&P 500 feel about the S&P 500. We got a little spike in volatility, earlier in the month, and then it calmed right back down. And then you can see a little bit of a pop today in volatility there. But generally, similar chart though, you can see where when price action gets really tight, then you get these moments where volatility breaks out. And you can see right before that volatile event, boom, it broke up. And you can see that typically happens when we get really tight charts. We see volatility coming, and it's the market whispering moments that something's coming. And so it's interesting, but is that something that you should react to with your portfolio, et cetera? No, probably not. Just from a short-term perspective, it's something you should pay attention to and have on your radar. We look at the MOVE index, which is a measure of complacency in the bond market, and it looks pretty complacent at this point. We're kind of low. However, you can see these areas when we get to these lows, we get a little pop up too. My guess is we see still some subduedness until we get into January. And then I think when everyone gets back into the markets and gets moving here in 4 days, then I think we'll see volatility move. And just a word of caution, like the markets don't care about our politics, right? So whether you like the incoming president or you don't, the markets just don't care. And it's true for my politics, true for your politics, true for everyone's politics. And that's why I love price action so much, because it neutralizes all that garbage. When we look at Dow Jones Transportation, if you think about this as the arteries of the economy. So if you think about, this is where all the blood flow of the economy happens. And the fact that we had this breakout, now a failed breakout on this long-term kind of consolidation period here. And then we broke out finally, and then we were right back in. That's not necessarily a good sign when you see that break down. I would envision you're going to see this area tested here over the next few weeks, around 15,000 on the transportation. And this is kind of a leading indicator of where the economy is going if you get these breakouts. And this was very much the honeymoon period for the elections. And then now it's come back into range. So the honeymoon period is over. And with IWM, which is really, if you look at those smaller companies, those mid-cap companies, I do like, though, that we seem to be holding support right here. But you can see similar election hype, double top, breakdown. Now we're sitting in support right over in this area. Again, I think there's a big wait and see in the market at this moment. We look at the stocks, which is kind of a leading indicator for all those high-tech flyer NASDAQ type companies. Similar look, you get that chart winding up. It is starting to break out. Let me adjust that trend line just a little bit there. Let's do this. I don't know. I mean, that almost looks like it's getting ready to break up. So this chart would be telling you that, see, you can see the wind up and then we're breaking up. This might be telling us that we're in for some higher highs on the tech side. This is kind of the front end of the risk curve. So the old concentration trade might not be done yet. This is the IGV, which is the very front end of the risk curve. These really high risk software, new startup type companies. You can see finding support on that 50 and holding so that is interesting. It's holding support, but looks like some weakness in that it's kind of gathering around that level. So usually what will happen is if you have a line of support, the market will trade in or trade down to it, test it. If it keeps staying there, eventually all the people buying in this area get worn out and then it falls through. So that's what's happening psychologically there. Happens on the bottom and on the top, right, on resistance, right? So if market's moving up and then it hits a certain spot, it'll pierce through it, and then there'll be sellers that sell right here, and then it goes back down and tries it again, and the sellers sell it again, it goes back down, tries again. Eventually, there's not many sellers up there, and then it breaks through, and modern day markets are happening such that when it breaks through, you get these short squeezes where you've got people who are betting in options, etc., and it goes through, and they might be betting against that, and if it goes through, all of a sudden they got to cover that trade, which then forces them to buy to get it up higher. So that's kind of the dynamics of the current, or the psychology of the current market that we've got. All right, let's take a look at Bitcoin just to see how that looks. That's been quite the news trade lately. You can see we broke up into the 100 space. We couldn't hold it. I think we got lower lows for Bitcoin right now. Again, we'll want to watch. It's only 11 o'clock on Friday, the 27th of December. We'll want to watch till 5, and that'll kind of give us a better read on that candlestick. But I could easily see a trade into the 90 range there. We haven't really tested that since we broke out as good support. And that's one of my favorite setups, though, is when something breaks up like that and comes back in. And then if it holds, I really like that zone from a trading perspective. But we haven't done that test there yet. And we'll want to see how that plays out. The fact that it couldn't really hold on to 100, meaning that every time it kind of went up to 100, sellers sold it. There's probably a lot of sellers that need to get worn out. There's a perfect example of what I was just talking about, where it'll keep trying to pierce through, and you can see all the sellers hit sell hard right when it broke above that resistance level, and that sold it off. But then you get the same thing going on the bottom, and you can see that right now with these wicks. See how the wicks kind of come down below 94, and the price action comes into this range and then the buyers are buying it up. But eventually, if it stays in that arena, there's not enough buyers, then what happens is that it just works its way down and breaks through. But there'll likely be a lot of buyers right in that 90 range. And you can see because it came up here, it moved really quick into this range. I think there'll be a lot of support right in that 90 space. But Bitcoin moves faster than most assets. It trades quick. It's open 24/7. So that creates a little bit more volatility and ability for the market to move. Let's take a look at NVIDIA, because NVIDIA is and has been one of the main drivers of this entire move upward. And I'd say we got some weakness there. You can see the green, which is a 50 moving average, is it's below that. It's trading below that. It's confirming below that. I think support's at 129, 130 on NVIDIA right now. Little ways yet to get back into that area. You definitely got this whole kind of zone right in here as a support zone, where when price comes into there, buyers will step in, buyers step in, buyers step in that area until those get worn out. And then if there isn't enough buying power in there, then that's where it falls below. But it does make me wonder if it's just correcting, given that what we're seeing in like the IGV chart, which I showed just a few minutes ago. Apple's really been the darling here in this last little go of the market. I mean, just relentless buying in Apple. Given how fast it's moved, I think you're probably going to get a correction in Apple here pretty quick. With there being a lot of support around 250. But why that's important is because when you've got a market that's very concentrated, like you have, when these big dogs, these are the S&P 500, when these don't do well, the market struggles. But this is the one-day performance of the stock market. So it's been a rough day, but if you actually look back at the week, it's a very different story, right? So today's been tough in the market, but generally where there's a pretty strong Santa Claus rally, today's, however, given that a lot back. So yeah, Apple being, one of the, if not the biggest company in the S&P 500, how it trades, so does the rest of the market. And so Apple really helped this whole Santa Claus rally rip and roar. And now it came back in today, but it found support on that 9 EMA, which is an important trading moving average. I could see, with that kind of support right on that blue line there, us going higher in Apple yet still. And this is just a correction. We're just checking in. But given that it's moved so fast, so quick, you look back in the history of Apple, we've definitely had periods where it's moved hard and gone up for a while, but then you get these consolidation periods, right? Move up, consolidates.
Case of timing is hard, Daren, because I don't know exactly where Buffett unloaded a bunch of his shares, but I know it was lower than where we are today. Right?
Yeah.
So literally the greatest
you mean
of
that
all
Buffett's
time.
not right about everything?
Yeah. Well, it's just, it's one of those things where everybody's susceptible, and timing it perfectly is impossible, especially if you're looking at it short run. So, just of note. And he's also, Buffett's got one of the best long-term track records, maybe the best long-term track record. And yet he's gone through multiple periods where he's underperformed the S&P for 6, 7, 8 years at a time, which when you're going through it, that amount of time feels like an eternity, right? I mean, heck, most people go 6 months underperforming and they're starting to get impatient, right? So, I guess a lesson there somewhere.
Yeah, it's, I guess when you're sitting on, it's something like 170 billion in cash, you can be picky, right? And he's certainly being picky and waiting for the right moment. Although I did see he got back into some more Occidental energy this week, which I thought interesting. Anyway, so yeah, nice week. Today's been a tough day in the market, but in general, we got a nice little Santa Claus rally out of it and gave it mostly back today. But there's still some light through the markets. I think right now you can't call it anything other than consolidation. I think we've got issues with this 10-year, and the 10-year continues to go up. However, it's in a big resistance area right here. So I think we will see some resistance on the 10-year at this point. If it keeps going, then things are going to break. So we want to watch that 10-year really closely because it's a very big indicator of and pulls through the rest of the market in an extreme ways. So with that, we're going to close it. We'll be back next week. And as always, if you have questions, reach out. Take care.